All right, thank you, Chip. How's everybody doing, guys? This is Bob Iacchino from Path Trading Partners. Mike Arnold is here as well. Thanks again for being here. We really appreciate the support turnout we get at these things. It makes them worth doing. Today we're going to do Nadex Spreads again, which has kind of become our thing. And we're doing trading at the money Nadex Spreads. We're actually going to show you a trading example and talk about the times when you should be looking at the money spreads, because obviously there's different times when you should be looking at the different types of spreads, meaning at the money, in the money, out of the money. And we're going to go into at the money Nadex spreads right now. When is a good time to trade them? But as always, Mike, as well as Nadex, all the fine people at Nadex, take the next slide very seriously. So I'm going to spend time reading it line by line. This presentation is for information purposes only and does not constitute investment advice, nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes, but only for use as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial conditions. Past performance is not indicative of future results. A couple of quick comments about this slide. Mike and I and some of the fine people at Nadex, we can do all we can to try and convince you guys to trade the right way and take the right amount of risk. What we cannot do is delve into your personal financial situation. So please take great care to only risk what you can afford to lose. It'll make you more comfortable, it'll make you smarter, it'll make you a more calm and consistent trader. And that's really the only way to succeed at these things, is to be calm and to be consistent. So please don't take excessive risk. We can't advise you on the amount of risk to take because each one of you is different. Each one of you have different personal situations. So please take a lot of care to use the proper amount of risk, put an amount of money into your account that you can stomach losing. Now, let's try and help you not lose it. But first, who is Path Trading Partners? We are a trading and education firm. We are not just an education firm. We do both. Our mission was to form a trading firm that educates, supports, and backs traders who are committed to probabilities, discipline, and long-term trading success. This is achieved by following the correct path. Always important that we point out we are not high-frequency traders, and we are not day traders. Those are labels, and they don't really apply to us. We are traders, and we are a firm that believes in long-term success in trading, covering time frames dictated to us by products, markets, and price action. In other words, why are we not high-frequency traders? Because we don't choose the type of trading we're going to do. Why are we not day traders? Because we don't necessarily choose the time frame that we're going to trade within or the days that we are going to trade. The market dictates to us what we're allowed to do. Just like in sports, where a coach will say we took what the opponent gave us, we take what the market gives us or shows us. So that's really how we do things. That's how we think all successful traders, and in our experience, successful traders that we've been around, allow the market to give them something, and then, we're kind enough to take it. Mike Arnold is a 24-plus year market veteran, and he's been teaching traders online and in person for over 10 years. He is a strategy and development consultant to multiple hedge funds. He still does that today. He is a former options market maker on multiple exchanges. He traded in Chicago, New York, Switzerland, and Canada. And he is the current head of technology and trading system development for Path Trading Partners. I do not have as impressive of a resume, but I've been around almost as long. I've been around 24 years. I've been teaching and mentoring traders live and online since about 2002. I've been a proprietary trader, an analyst, a fund-of-funds, hedge fund principal, and that is where I think I bring value to situations like our education, because I've analyzed a lot of other traders' methods and track records, and I've mentored and taught over 5,000 students to this point. I still appear on TV. I've done about 700 interviews so far, and I continue to appear about 5 to 10 times per month. That's enough of that. Nadex is recording this, by the way, so if you want to read either one of these bios in detail, you'll be able to go to Nadex's website in the next couple days and check out a recording of this, and you can pause on either one of these slides. So let's review some prior classes we did. For those of you that weren't around for those, again, you can go to the Nadex website, go to Education, go to Webinars, and then go to Archived Webinars, and you can find all our other prior Nadex classes. It's kind of important that you master those earlier classes before you try to attempt a lot of the things we're going to show you in these next few trading Nadex spread classes that we're doing. But in prior classes, we covered the concept of moneyness and classifying a spread as either in the money, at the money, or out of the money. We taught the concept of spread premium and looked at how to determine both intrinsic value and extrinsic value. We taught the Greeks, what they are and how they apply to Nadex spread. Again, if you haven't seen those, highly recommend. We've also got links to them on pathtradingpartners.com, but you can go on Nadex's website, webinars, archived webinars, and you'll find them down there. It's important that you learn this stuff because Nadex spreads as well as Nadex binaries are options. So learning how the Greeks apply to both, and they do apply slightly differently, is kind of important going forward if you're going to trade these things successfully. If you need to learn these concepts, as I rambled on about them a few minutes ago, please watch the recordings of our prior Nadex spread classes after this webinar, and you can find them here. This is the actual link. After learning the Greeks, most traders wonder how they can effectively translate that knowledge and information into useful and actionable trading information. That was the biggest question we got. So how do we do it now? Once we understand, how do we do it? This is what we're going to do when we look at how to trade at the money Nadex spreads. However, first, we're going to do a very brief review to ensure everyone is on the same page. So let's do that real quick. So at the money, we refer to a Nadex spread being at the money when the price of the underlying is trading at the floor price when trading the spread long. Conversely, if the price of the underlying is trading at the ceiling price when you're trading the spread short, it is also at the money. So here's an example. If you're looking to go long a Nadex spread, here's an example of the US 500, which is obviously the S&P 500, where the E-mini is the underlying. If the S&P 500 is trading at the floor price of 1900, then the spread is considered to be at the money. Here's what it looks like. This is, you've seen these in our other webinars. Here is where the spread is considered technically to be at the money. It's a quick visual. Here's a visual of a short. If the S&P 500 is trading at the ceiling price of 1940, then the spread is considered to be at the money if you're looking to go short the spread. Just the same situation, just conversely, right? That's all we're looking for right there. That's a quick definition of at the money because you'll need it in this particular webinar. Take a look at Nadex spread premium. What makes up Nadex spread premium? Well, Nadex spread premium is the price that you would pay to either go long or go short. Remember, they're debit spreads. So whether you're going long or you're going short, you're going to be paying. There's going to be money pulled out of your account when you put these spreads on. So Nadex spread premium consists of the intrinsic value, which is the value at expiration, so the price of where it is now versus where it would be at expiration, plus the extrinsic or time value. That's what makes up the Nadex spread premium. You put those two together and you've got the premium. Let's take a quick look at the Greeks. We can apply these Greeks to Nadex spreads. The definition of each Greek, try and say that fast, each Greek. The definition of each Greek is as follows. Delta is the sensitivity of the spread price to price changes of the underlying. Now, we're not talking about the spread price being, in the prior example, it was 1900 to 1940. Those don't move. It's the premium, the price, the sensitivity of the spread price to price changes of the underlying, which would be the S&P or the E-mini S&P 500. Gamma is the sensitivity of the delta to the price changes of the underlying. So how quickly is the delta going to move as the underlying price changes? That's what the gamma is. Theta is the sensitivity of the spread price to the passage of time. You'll often hear theta referred to as time decay because generally Theta is starting at a higher point and creeping lower and lower and lower. Not always. But theta, you'll hear that referred to as time decay. So theta is the sensitivity of the spread price to the passage of time. Vega is the sensitivity of the spread price to changes in the implied volatility of the underlying. We cover that in those prior webinars as well. And then rho is the sensitivity of the spread price to changes in the interest rate, and we will not be looking at rho since we're trading spreads on a short-term basis, and rho will not affect the price of the spread the majority of the time. We're talking about 99.9% of the time there's going to be no rho in the trades that you're looking at with these particular Nadex spreads. So we're not going to be talking about rho at all. So the extrinsic value components. What is extrinsic value made up of? Well, it's made up of the time until the spread expires, which is the theta, the volatility of the underlying, which is the vega, and then the changes in interest rates, as we just said, does not really apply. So it's easy to calculate how much of the intrinsic value there is in an option at this point, or in a Nadex spread. A little more difficult to calculate what the extrinsic value is. So it's the time until the spread expires plus the volatility of the underlying. Those two make up extrinsic value. All right, I'm going to give it over to Mike for this portion of the webinar.
All right, thanks, Bob. Thank you, everyone, for attending. Hope everyone is doing great. All right, I'm going to go over what we're going to cover in this session, and then Bob will come back on to wrap up a sample trade. So pay attention so you can apply and you can learn what you've applied as Bob walks through the sample trade. But first, in this session, we're going to examine in depth how time, theta, volatility, vega, market direction, and momentum affect Nadex spreads when trading them at the money. This session will only focus on trading the Nadex spreads at the money. Other classes will focus on trading them at in-the-money locations. We're going to have one on null point. We're going to have one in the money for theta capture. So there's different locations, and we're focusing on the major locations of these, everyone. We're not trying to get it down to every place you could possibly trade the spread. We're going to first key on the major locations so you get the real focus of this and how the vega, the theta, the market direction applies. If you get them at these three major sections first, and then you understand these graphs I'm going to go through that we've gone through in past webinars and we're going to revisit in this one, you'll really understand wherever you're putting it on, you know, if it's in the middle of at the money and the null point, pretty much how that's going to behave. But it's key to get these locations down first. We will also mainly be focused on trading the spreads from the long side for the point of simplicity, although all the information we present directly applies to trading the same spreads at the money from the short side. And what I mean by that, in the next few graphs and slides I'm going to be going over, we're not going to be talking about it from trading it at the floor price for the long, or if you're at the money from the short side, we'd be trading it at the ceiling price. Now, the example that Bob's going to go through, the trade example, is a short trade. So we will be covering that aspect. It's just at the end of this. So for these graphs, it's focused on the long side also, but it equally applies to trading it from the short side at the ceiling price. Many traders look to trade the spreads at the money or even out of the money because they look at the reward to risk ratio and they see that they can get a potentially large reward for very little risk. This is true, but the trader needs to understand the market conditions that are appropriate to initiate these kinds of trades. Not every market condition is suitable for trading at the money or even out of the money, you know, further below the floor price for that long trade. Just trading a spread because it looks like you can make a lot of money without a lot of risk is not a sound strategy. Now, there are ways you can look at, hey, my risk reward is great, or my risk reward is not so great, depending on where you're putting it on. That's only part of any consideration when trading a spread, because it also matters the strategy you're trading. If you're going to, like if you're trading in other locations, if you're going to exit the spread early, are you going to take profits early? There's many components that play into the full reward to risk ratio. You also have to understand how implied volatility and time are going to affect where you're putting on the trade. And are those things working for you or against you? All of that plays into account, which is why we're doing these classes. Some traders get so focused on just looking at the final reward to risk. Well, if this goes all the way from the floor price to the ceiling price, I can make this much money on expiration with only this amount of risk. Well, that is a true statement. But that's only one component of the whole makeup of why and when and how and what you're going to do when you take a trade. Once you understand the market conditions that can be beneficial to putting on a Nadex spread when it's at the money, you will be one step closer to becoming a complete spread trader. That's really our goal here, to give you the information so even if you have to watch this session a few times, you start to add it into your trading repertoire with whatever strategy you're using or whatever trading techniques you're using to initiate trades. You say, hey, I now know based off these market conditions, this would be a great kind of spread to target putting on. Or these are the kind of market conditions that are really suitable for me to trade in the spread at the money. So I'm going to find the spread that's trading at the money or near to at the money, and I'm going to execute that spread for this trade because it fits in with my strategy and it fits in with these market conditions. That's our goal. All right, so the long spread at the money. This is a sample US 500 2000 to 2010 Nadex spread. At the money is right here. We're trading it at the money. Now, throughout this whole point, and we'll touch on some of this at the slides, if we're slightly below here or slightly above here, I'm still going to talk about it at the money. But if we were trading it here, it would not be at the money. If we're trading it up here long, it would not be at the money. Okay? We're focused in this vicinity for trading it at the money. You know, it's slightly going to be different prices. We're going to have different, you know, out of the money has only extrinsic value. As you start to get in the money, we incorporate some intrinsic value. But pretty much everything I'm talking about, if we're in this vicinity, holds true. So that's what I want. You're not going to say, boy, I'm going to want to trade this 2010 Nadex spread. But it's trading right now at 1999.5, so I'm not really trading it at the money. Well, yes, you actually really are trading it at the money because it's right in this vicinity. Or if it's trading 2000.5, well, yes, it's slightly in the money, but it's still right at the money. We're talking about this vicinity. Extrinsic value. When trading Nadex spreads exactly at the money, there's not any intrinsic value. The value is all extrinsic value. You're right on the cusp of where you start getting extrinsic and intrinsic, but technically right at the money is all extrinsic. If you're trading a spread slightly below the at the money price, there's also only extrinsic value, and we've covered that repeatedly in prior webinars. If you're trading a spread slightly above the at the money price, there will be a little intrinsic value, but it will still mostly be extrinsic value. So that's what I was sort of talking about visually on the prior slide. We're talking about that area, so don't get hung up. Well, I'm slightly in the money and I'm slightly out of the money. All right, you're virtually at the money, and there might be a little intrinsic value either way, or all extrinsic value. Just grasp these concepts. Since all the value is extrinsic value, time is working against the trader. All right, there's nothing, the spread isn't worth anything intrinsically. So if the price were to sit there, or I mean, it can trade up and down a little, but virtually not move until expiration, the spread would expire worthless because it has no intrinsic value. Remember, the intrinsic value is what the spread would inherently be worth at expiration. So if price action is stagnant and not moving further into the money, then every minute that passes hurts the ATM spread trader. It should be moving towards that, you know, further and further into the money. So if you're long, it should be going up. If you're short, it should be going down. This is especially true as the spread gets closer and closer to expiration. Theta really starts to kick in more and more, and theta is the time decay as you get closer and closer to expiration. It is not linear. So let's take a look at the spread value in theta. Remember, theta is the time decay of the spread. Theta can help or hurt the spread trader depending on where the trader is trading the spread. But as long as the underlying price remains close to or at the money, time is working against the ATM spread trader. Therefore, theta is decreasing the extrinsic value every minute that passes. You notice it because theta gets more and more extreme as it gets closer and closer to that expiration. But every minute that passes, since that spread hits the market, so if it's a 2-hour spread, every minute that passes, theta is eating away as long as that spread is at the money. As the spread approaches the expiration time, the time decay increases rapidly. Here's an example. Now we're just looking at the price versus time. So with 120 minutes to go, which is this dark green line, if it's sitting right at this 2,000, so we're trading this at the money long, we're saying, and this is a hypothetical example based off a certain volatility, and we're not changing the volatility at all in this example. The only thing that's changing is time. So if we were to put this on, it's extrinsic value only, at the money, we'd be paying, you know, somewhere around maybe $2 and slightly below 2.5, maybe $2.40. So this could be trading at 2002.4. All right. That's extrinsic value only. And if you look, if that's same, nothing else changes except time decreases. The underlying is still trading at this 2,000. It's now with 90 minutes to go worth only $2. 60 minutes to go, maybe worth about $1.80. 30 minutes to go, now we're down, you know, we're down to maybe this $1.30. 15 minutes to go, it's now worth, let's call it 90 cents. 5 minutes to go, we're still at the money, maybe it's worth 50 cents. So the underlying didn't change price, the only thing that changed was time, but you see, as it keeps going, the spread value, theta is working against you. The spread keeps decreasing in price because the underlying is not moving. And then at expiration, of course, at the money, the spread would be worth 0. Here's that graph of the theta, and this is a graph of theta at the 15-minute snapshot. Remember, theta changes each minute that passes, so we have to take a certain snapshot. This was 15 minutes to go. This is what your theta curve would look like, and this again is at a specific implied volatility. You see how theta is negative. What this theta being negative is saying is every minute that passes, you lose a certain value of the spread price. Whereas if you were trading up here, close to ceiling price, and you were long, every minute that passes, it actually increases the spread price. And we'll get into that in another lecture, but you can see up here, this is just a preview, if you were just sitting here and price was sitting at the ceiling price and you were long, actually it's the value gets closer and closer to the full value as time gets closer to expiration. That's what the theta positive up here means. However, we're looking at the money, the theta is negative. And you can see how it's the most negative at the money. So the greatest effect of theta or your time decay is right where we're looking to trade this spread, which is at the money. Here's how the theta changes first time. With 120 minutes to go, we're losing just a little value for every minute that passes. As we get closer to 90 minutes, we're losing some more. As we get closer to 60 minutes, we're losing more with every minute that passes. 30 minutes, we're even losing more. You see how it's starting to spike further and further down? So if we look, the first 60 minutes that passes, compare this dark green line at 120 minutes to the blue line at 60 minutes. Here's the dark green line, here's the blue line. It only changed by this much. However, then let's even take a look at the next 30 minutes. Going from 60 to 30, it changes even more. So you have more time decay that's happening going from 60 to 30 than from 120 to 60. Look at the next 15 minutes after that. We go from 30 to 15 minutes, your time decay is even decreasing, which means it's eating away at your spread price more and more every minute that passes. And look at this, 15 to 5 minutes, it's now really eating away at that extrinsic value of your spread. So if that underlying is not moving, that spread value starts decreasing rapidly in the last 15 and especially in the last 5 minutes. That's what I want you to take away from this slide. What are we gathering so far? We do not want the spread, the underlying price, if we're trading something at the money. Of course, we don't want it to go against us, so we don't want the underlying going farther out of the money to begin with. I think we all agree that's a no-brainer. If we believe the underlying is going up, we're looking to trade this long. If we're looking for the underlying to go down, we'd be trading this short. So just a given that we're trading this spread long, we're looking for the underlying to go up. But we especially don't want it to sit here. Sitting here hurts us trading it at the money and hurts us more and more as we get close to expiration. So let's now tie this into some market conditions you might want to be looking for to initiate these trades. It's best to trade at the money spreads during busy market conditions. ATM spreads or at the money spreads should not be put on in quiet or stagnant market conditions, especially close to expiration. If the trader expects market conditions to get busy and is trading a spread with significant time to expiration, then it's okay to establish it during quieter conditions. For example, the US 500 9 to 11 a.m. spread being put on between 9 and 9:30, since the US future market opens for US markets at 9:30, which creates busy market conditions. So let's say you're putting this on even before 9:30. It's all right, fine. We've only had a little time decay. We still have an hour and a half. Let's say you're putting this on right at the futures market's open. So we're putting this right on at 9:30. Fine, because we're going into very busy conditions, what normally are very busy conditions. So that's fine. But why do we want to trade these during busy market conditions? Because there's more of a chance that price is going to move and not stagnate. Now, price can stagnate at any time, and everybody's seen that. Even during busy market conditions, price can start trading in a very narrow range, especially if a report's coming out or people are expecting something, or there's certain times that just markets get quiet. However, there's more of a chance of price movement during busy market conditions. Why don't you want to put it on in quieter, stagnant market conditions, especially close to expiration? Because that ties into what we just looked at. Close to expiration, stagnant market conditions, it's not moving. This theta is getting more and more extreme and working against you. That's not what you want. So that's why we're saying you don't want it close to expiration, quieter, stagnant market conditions. So we're really targeting, hey, busy market conditions, maybe lunchtime, or maybe like trading currencies at early evening when the it's maybe just the Australia, New Zealand markets. Maybe Japan's not even really busy yet. That's probably not the best location unless some news is out or something's triggering that market to be pretty volatile and moving around. That's probably not the best conditions for those kind of things. Busy market conditions can lead to a couple things. First, it can lead to trending market conditions, which is beneficial to ATM spread traders. Why? Because you want the price to move away from your at-the-money price. For a long, you want it to move farther in the money. For a short, you want it to move down away from the ceiling, farther in the money. Second, it can lead to stable or increasing implied volatility, which is also beneficial to at-the-money spread traders, and we will show you graphs on that. The trader does not want price action to remain at the money for too long or move out of the money for an extended period of time, especially as time gets close to expiration. I'm going to keep stressing this. Theta is going to work against you, especially close to expiration. We need to have this spread moving into the money. Otherwise, every minute that passes hurts the at-the-money spread trader. The trader needs to have a moderate to strong directional bias, which will take the underlying further into the money. You want the price to really be moving. There are certain other conditions that, let's say you have just a slight bullish bias. There might be a better place to put on a different spread. If you're looking at ATM spreads, you want a moderate to strong directional bias. You don't want, well, I'm not sure if it's really going to go up or if it's just going to sit here. That's not conducive to trading at the money spreads. Now let's tie in the Vega or volatility component or implied volatility component. An increase in underlying volatility can lead to an increase in the implied volatility of the spread. Remember, underlying volatility has some correlation with implied volatility. It's not always, okay? But generally, if the underlying is getting more and more volatile, implied volatility will generally not go down. It will either stay constant or move up. This is beneficial to the at-the-money or slightly out-of-the-money Nadex spread trader if price action remains closely at the money strike price. So even if your market's not moving yet, but implied volatility is going up, it can still help your spread price. The at-the-money spread trader does not want the implied volatility to decrease because it hurts the at-the-money spread trader. So you don't want implied volatility going down. As time approaches expiration, the effects of volatility decrease. So every 1% increase in implied volatility for the at-the-money spread trader increases the price of the spread. Conversely, every 1% decrease in implied volatility decreases the price of the spread when it's at the money. So here's where we're sitting on the curve. This is a specific timed expiration because, again, you can never separate time or implied volatility or any of the inputs to these models separate from each other, but this is a snapshot at a specific time, and you can see it's a snapshot at a specific implied volatility. We're saying this is 35%. So you can see at the money and slightly out of the money, your Vega is positive. That means for every 1% increase in implied volatility, this adds to the spread price. So if the underlying does not move and implied volatility goes up, this is actually adding value to the spread price. If implied volatility goes down, it actually subtracts value from the spread price. Conversely, when we get into future webinars, when we get down here, the implied volatility changes have a different effect because it's now negative. So a 1% increase would actually detract from the spread price. A 1% decrease would add to the spread price, and you'll see that in future webinars. Right now, to tie this back to at the money, every 1% increase adds to the value of the spread. A 1% decrease in volatility subtracts to the value of the at the money spread. Here's an example of our price of that spread, and the only thing we're holding time stagnant. Time is not changing in this example. The only thing that's changing is the implied volatility. Here's the at the money price. So if we go from 10% implied volatility to 35% implied volatility, but the underlying is still trading at $2,000, look at the price of your spread. It goes from approximately, let's call this $1.40 to $3.40. So by just changing the implied volatility without the price of the underlying, the spread price will increase. That's why we're saying we want, if volatility is going to change, we want it to be going up or holding the same. If it's holding the same, it's fine because it's not changing your spread price, and many times it will hold the same. You do not want this you do not want to trade this in stagnant market conditions with falling implied volatility. Let's say we're stagnant, meaning the underlying is not moving, and implied volatility starts dropping. Maybe we just had a big news report and the market said, that's nothing, I'm not, you know what? The underlying just starts going range bound and doesn't move. And so the implied volatility starts getting sucked out of the pricing model of the spread. The market makers start reducing their implied volatility in the spread. Okay, so we put it on, let's say, before the report because we thought this thing was going to move huge. Oh, we're up here, you know, with a certain amount of time to expiration. We're at 35% volatility. Market report comes out. Market's not moving. It drops to 30%. It drops to 25% implied volatility. Market's not moving, and time's still passing, which isn't even captured here, but just implied volatility is reducing the cost of your spread. That's working against you. Here's a graph of now how Vega or implied volatility, the implied volatility component changes versus time. So you can see with more time left up here, the Vega, if volatility does not change, volatility with more time left affects the spread price greater than with less time left, okay? So if there's, like, let's say 5 minutes left, increases in implied volatility aren't going to change the spread price that much, and neither are decreases. However, with 90 or 120 minutes left, increases in implied volatility are going to affect the spread price much more positively if you're long the spread at the money price, whereas falling implied volatility is going to hurt your spread price much more with more time left. Keep that in mind. So the effects of implied volatility changes decrease as the spread approaches expiration time. That's the key takeaway from this slide. Let's revisit delta now. It is important that the trader understands the delta of trading a spread at the money. Remember, delta is the amount the spread price will move in relationship to a 1-point move of the underlying. So if the delta is 0.5, then the spread price will increase or decrease half as much as the price of the underlying. That's key. Let me restate that. So if the delta is 0.5, then the spread price will increase or decrease half as much as the price of the underlying. So if the underlying were to move 1 point, the spread would only increase or decrease half a point in value. Delta versus time. It is interesting to note that the passage of time does not have much effect on the delta when trading the spread at the money. The delta remains close to that 0.5 value. If the spread is trading just below at the money, then the delta will decrease rapidly as the expiration time approaches zero. That should say approaches zero. If the spread is trading just above the at the money, then the delta will increase rapidly as the spread approaches expiration. An agile trader trading spread at the money when price action is trending towards the null point can take advantage of the rapid increase in delta. Just for a recap, the null point is the middle point between the floor and the ceiling. We call that the null point. You'll want to tune in for next week's webinar because we go over a lot of stuff regarding the null point and how to trade these spreads as a null point. So, in this example right here, here's delta versus time at the money. At the money is just 2,000. You see there's slight changes. So with 120 minutes to go, you know, the delta might be maybe 0.45. With 5 minutes to go, it's right around 0.5. So it does change a bit. It does increase as the timed expiration gets closer to zero. However, it's not dramatic. Look at what happens if you're out of the money. Let's take this, so we're long and we're out of the money. Let's say we're at 1998. Look at this, what happens to your delta. At about 120 minutes to go, this delta is maybe, we'll call it 0.37. We get down to 15 minutes. It's now already dropped to 0.2. So it was at 0.37, every 1 point change positively in the direction just moving further into money would increase your spread price 37% of the underlying price. However, with only 15 minutes to go, it's only going to move about 20%. With 5 minutes to go, when it's this far out of the money, it's only going to move maybe 5%. There's very little change, though, at the money. So you don't really need, as long as the spread is at the money, no matter what time you're looking at, it's pretty much going to be around this 0.5 value. All right, which means as the underlying moves closer and closer to in the money, closer and closer to this null point, which would be the middle point between the spread, you know, your spread price is going to increase about half as much as the distance the underlying moves. And as it moves further and further towards that null point, you can see how that delta starts increasing. All right? So now if we move from 2000 to 2002, your delta is actually higher, especially with very little time remaining. Like with 15 minutes to go, you know, your delta at 2002 is now, we're looking at about maybe 0.85. So your spread price is moving 85% of the amount of the underlying. So this is beneficial if you put it on at the money and we're moving close to the null point, you're moving further into the money, especially with less and less time remaining, your spread price is moving faster and faster higher. It's getting closer and closer to moving one-to-one with the amount of the underlying. So we've sort of touched on optimal conditions so far. Let's reframe this and look at some non-optimal conditions. As I said, we've outlined some conditions we're looking for to consider entering an ATM Nadex spread. Let's rephrase them and look what the non-optimal conditions would be. It helps people to look at both sides of the coin. We are not looking to trade at-the-money spreads in quiet market conditions with very little movement. You should understand that now, because that time decay, that theta, is working against you. We are not looking to enter these spreads with very little time left, especially with very little market movement. Why? Because that theta gets really, really big. Okay? And it's just going to destroy all that extrinsic value of the spread. Significantly decreasing volatility combined with stagnant market condition hurts the at-the-money spread trader. That is a deadly combination. Your price is not really moving, and your implied volatility is coming down, which is just eating away at the extrinsic value. So if you're especially close to expiration, if you have decreasing implied volatility, theta really kicking in close to expiration, and the price is not moving, you do not want to be in an at-the-money spread. Keep that in mind. Take those notes down. Examples of non-optimal conditions. So here's where we wouldn't consider. Here's just a couple examples. Early evening trades in currencies and usually in equity indices and commodities. Why? Because they're generally not moving that much. Now, yes, if there was some big news event, something came out in Japan like that's affecting some of the currencies, they're really moving, that's a different story. Most evenings, if you look at currency trades, you know, early Japan hours or even Australia and New Zealand hours, a whole bunch of stuff's not moving. If you look at the equity industries, you know, they close, they reopen. There's not, unless there's major news out or something's happening or there's something triggering a lot of volatility in the markets, the equity indices aren't moving around. And a lot of people aren't trading these things, making a move around. That's not a great time when you want to put on an at-the-money spread to just have it sit there and time just eat away slowly at your position. A long time before a major report release. For example, putting on an at-the-money spread at 12 p.m. that expires at 2 p.m. when there's a major Fed announcement that's expected at 2 p.m. A lot of times the markets will go really quiet. Let's talk about like the E-mini S&P or the Dow or the NASDAQ. You know, something that's really good could really move given a Fed announcement. You know, maybe it's a Fed announcement on interest rates. Maybe it's something else they're doing. People they're like, well, I'm going to wait for the announcement. So price, and I'm sure anybody who's attending this who's watched the market before these announcements, liquidity dries up, and in the underlying, that's what I'm talking about. And, you know, the price, it still trades, but it doesn't trade that much. So if you're sitting there putting on the spread at 12 p.m. that expires at 2 p.m. and the report's not till 2 p.m., the conditions are ripe that underline's not going to move that much, and that time decay is just going to be eating away at your extrinsic value, eating away, eating away, eating away, and the chance that you make money on that spread is getting less and less and less. Why? Because that market will move at 2 p.m. However, your spread has expired at 2 p.m. So that was not a great way to position an at-the-money spread trade. Now I'm going to turn this back over to Bob, and he's going to walk you through an optimal example. And keep in mind, guys, I've been really focusing on the long side. Bob's not going to give you it's going to be a short example, but you're going to be able to take these same components and apply them to Bob's example.
Let me give you guys a short example of a short example. How about that? We've been talking about non-optimal conditions for taking any at-the-money spread, long or short, really. So let's talk about some of the optimal conditions, and let's look at an optimal example. Conversely, here are some optimal conditions when a trader may consider an at-the-money spread trade. If a trader has a strong directional bias with expectations of stable or rising volatility going into busy market conditions. Let's review a path trading setup that would be suitable for trading at-the-money Nadex spreads. A couple of things before I put the chart up. I'm sure at least 1 or 10 or 20 of you during this whole example have said, well, you know, that's great, Mike and Bob. How do I know when volatility is going to rise? How do I get a strong directional bias? I mean, there's other things that go into play. When you're trading Nadex spreads, you're trading option spreads. Okay, Nadex is an exchange with real products. These are real options. So you do have to have underlying knowledge and underlying training or skill set to have these things going in. And then on top of that, you have to layer the knowledge of when to trade at the money, and that's what we're trying to go into. So I'm going to give you an example of a good at-the-money short, and here is what the chart looked like at the time. Trading a short at-the-money spread, and you could probably see from the pricing that this is crude oil. So crude was breaking down from congestion. Up here to the right, you can see some sideways congestion after a decent-sized up move. Now, this is a particular pattern, a very specific and proprietary pattern. It's called a double top, but we teach it in a very specific way. So this is a breakdown from a double top, but it's also a close beyond a path trigger trend line. Now, this triggered at 10 a.m. with this close down here. All right, so now we have a strong belief that momentum is heading to new lows on crude. You've got a lower high from the previous high, then you've got a lower low from the previous low. We've got a potential double top that is triggered, and we've got to close through what we call a path trigger trend line. So we have a pretty good idea the momentum is heading to new lows. Right? We've also got an idea that it's going to go fairly abruptly simply because of the triggers involved in this particular trade. Doesn't always happen, but when things move abruptly, volatility tends to move in our favor for an at-the-money spread, right? Tends to move up. So in this particular pattern, we have 3 targets based on path reversal pattern and path clear path targets, right? Based off of these particular things, we would have 3 targets on this particular chart for crude oil. If we were trading crude oil, no problem, but we're trading options, right? So we have to choose the right options as well. So our targets for this are 32.65, 32.05, and 31.75. Again, for those of you that are already students at Path, you know how to do this and you know how we got these. But based on that size of a move, we're also looking for rising volatility. So if we go to our available at-the-money spreads at the time, you notice that, remember what we said on those charts earlier, that if you're at the floor of a particular spread, if the underlying price is at the floor for a long, it's at the money. And if it's at the ceiling for a short, it's at the money. So here you can see the indicative index, right? The crude oil at NYMEX was at 33.25, right? The indicative index was priced there, but the crude oil was going to be somewhere close, right? You can look that up on Nadex's website. But you're looking at the indicative index at 3325.7, and the ceiling of this particular spread at 33.25, right? So we want to go short this. So we look to enter this spread on a pullback to a key reversal zone with the 31.75 to 33.25 spread being at the money. Now, the reversal zone is not important, but that's when we looked to add or to get into this particular trade. And for us, a quantity of 3 was used. Okay, so we shorted 3 spreads, and we entered at 32.99. So we sold 3 of these particular spreads, right? There's a lot of people who don't understand the concepts of at the money, in the money, out of the money, might have wanted to play it somewhere with this particular spread thinking, oh, I don't know how low it's going to go. But having an underlying strategy in place tells us that at the money not only was the right thing because of our direction, our strong directional bias, but because we expected the move to cause rising volatility. So we entered right here. Notice as well, this would have been an at the money for a long. this 33.25 to 34.75, right? And I'm not going to point it out, but you can watch the bid and ask on these just kind of waste away as we move lower on the next couple of slides. So we entered 3, we shorted a quantity of 3 on the 31.75, 33.25 spread, and we entered them at a price, the bid price, of 32.99. Now the spread continues, and the first target was reached, and one spread was closed. Now this is something that we've always done. You know, so we took the screenshot after it hit it. But here's our first target, right? Based on, again, a specific pattern and a specific rotation type that we teach. But this was where our first one was taken. So we took one of those off at this point. And we covered that one at 32.46 at the offer side. Okay, same spread obviously, but we took one of those off. Why? Because one of our targets was reached. We always do that. We have always done that. You'll kind of see why we start to cover these. Continuing on lower, the second target was reached, and the second spread was closed out at the level down here, which we talked about earlier. Okay? And again, there's a rotation here. It's also the initiating point of the trigger trend line, which again is something proprietary to Path. But we covered there. We now have one remaining short, and we covered that at 32.44, and we've got some profits in. Right? We've taken some profits in, and we've got one trade still on. As you continue on with the trade, it goes down and it reaches our final target, which again is the bodies of the candle on the move here. Again, something proprietarily that we teach. But the third spread was closed out with a price of 31.91. Now, why didn't we leave it on? We had profits in the books already, right? We could have maybe left one on. Maybe we could have left them all on. If we thought it was so hard, you know, why wouldn't we just keep it on, take the full profit on all three? Because we don't think like that. Okay, we take what the market gives us. And trading an at-the-money spread here was the right thing to do, and trading it the right way was also the right thing to do. Profit comes when you follow the correct path, when you take the right actions, whether they make you the most money on this particular trade or not. Because on the next one, it will be the right thing to do. You can see the clear reaction to our third target right here. Now, I don't have another chart to show you guys, but I can tell you if you look at crude recently, it's rallied from here since. Okay, there's been some gyrations. Don't get me wrong. This has happened over a course of a few days. Not this particular trade, but crude oil, this is a days-old chart. But there's been some gyrations here. What if the market would have reacted here or would have reacted here? We have these levels for a specific reason. So we cover our trades at our targets, and we trade with targets. We always have. One of the great things about Nadex binaries and Nadex spreads specifically is that there's built-in targets if you don't have the discipline to trade with targets in the first place. But having an underlying strategy and knowing when to trade the at-the-money spreads puts so much probability on your side that you'll see your results improve almost overnight. If you remember, and if you don't remember, you can review this, because again, Nadex is recording it. But if you remember when the at-the-money spread is the optimal spread to put on. Okay, there's times to put on the other ones. There is. And we'll go into those in coming webinars. But the at-the-money spread is the most common. In this particular case, this particular trade we're showing you, all three targets got reached. That's not always what happens. We don't always have three targets to the trade. Okay, but in this particular case, three targets were reached. We cover each one at the levels that we said we would cover them. And the Nadex spread that we took was the right one because it was basically exactly at the money. So in this webinar, we covered various aspects of trading at the money Nadex spreads, and we examined how some of the Greeks affect the spreads. We also looked at the optimal and non-optimal market conditions, which can help a trader determine when to trade this spread at the money, when to trade a spread at the money. Keep in mind that when you're trading options, which is what Nadex spreads are, okay, they are debit vertical spreads in options. And when you're trading those, there are other things, sometimes major things, depending on the time to expiration, the volatility, and the movement of the underlying. There are other things that affect the spread that you're in, other than just the movement of the underlying. So what we're trying to do with our first few spread webinars is kind of clear up the fog of why that happens. Now we're going into optimal times to pick the right spreads. It's very important you pick the right spread when you're doing this, because again, this is a derivative of a derivative, all right? Extremely, extremely effective and great product that they've made because they've taken a lot of the complications out of vertical debit call spreads, and you have them here to trade. It's just a great product, and that's why we've chosen to kind of focus on these for these webinars. You'll probably need to review this information multiple times and then determine how this information can work to further help you successfully trade at the money spreads with your trading strategies. Remember, trading strategy first, and then you apply your strategies and the conclusions of your strategies in the Nadex spread market. Next time, we're going to look at trading Nadex spreads at the null point. Do me a favor, guys, if you never heard null point, please go watch the other webinars because we talk about the null point and what it means. We will again look at the market conditions that are beneficial and detrimental to trading the spread at the null point, and it'll be helpful for a trader to again review the Greeks and the various characteristics of them and how they apply to Nadex spreads. So when we're done with the webinar next week, you'll know when to trade at the money spreads and when to trade null point spreads. That's going to be a lot of ammunition. Okay, those are a lot of bullets right there. So please tune in next time as well. Follow us on Twitter at @path_trading. Like us on Facebook and visit us, please, at pathtradingpartners.com. There's a lot of free stuff there as well. Webinars, blogs, a lot of links to some of the Nadex stuff that we've done. And we would love it if you guys would listen to our podcast. If you're interested in anything other than just, we do a lot of Nadex stuff on our podcast, but we also talk about stocks, we talk about futures, and we talk about some other stuff, some kind of personal stuff too. So please go to the Money Path. It's available on iTunes and Android. And then again, read our blog articles, which can also be found on Path Trading Partners, sometimes on Benzinga. Mike just wrote an article for technical analysis of stocks and futures. Mike, I don't remember the name of the magazine, but that'll be coming out in a month or so. So check us out, and we're happy to answer any questions while you have time.